Listen to me. When a market starts moving this fast, the money isn't made by the loudest people in the room. It's made by the people who can keep their head while everybody else is losing theirs. And right now in the metal space, you can feel that something's about to snap energy in the air, because prices are ripping, headlines are screaming, and a whole lot of folks are about to learn the hard way that a chart can punish you, even when you're right. Alright, let me set the scene. I'm on the floor at a packed resource investing conference, and the vibe is different. Not casual optimism different, I mean electric. People aren't chatting like it's a hobby, they're leaning in like it's survival. Gold has been flirting with that $5,000 level, silver is whipping past $100. And the price action is so violent that if you blink, you'll miss a whole week's move in a single morning. Now, here's the part that should mess with your brain. When prices are exploding, the question isn't, should I buy? The real question is, how do I not do something stupid? Because the fastest way to wreck a great trade is to let emotion take the wheel at the exact moment the road gets icy. So I sat down with a veteran money manager, someone who's been through multiple metal cycles, someone who's seen crowds like this before, and I asked the question everyone whispers when the candles turn vertical. Is this the beginning? Or is this the part where you take profits and run? And before I tell you what he said, I need you to understand why this answer matters more than you think. Because if you get this wrong, you won't just lose money, you'll lose confidence. And once you lose confidence, you'll hesitate on the next opportunity, right when it's finally the right one. He didn't hesitate, he said, "We're nowhere near a real top." And I'm telling you that sentence landed like a brick in the room, because a lot of people secretly want permission to believe the move is still early. They want a clean, simple story. Just hold and you'll be fine, but the market doesn't reward simple stories, it rewards discipline. So I pressed him. When you say we're not near a top, what are you looking at? And he didn't start with charts, he started with people. He said the crowd feels big because this room is full, but this room is not the whole world. This room is the old guard, people who followed metals for years, maybe decades. The real mainstream crowd, the dentist, the teacher, the accountant, the guy who never owned a miner in his life, he's not here yet. And until that guy shows up, you don't get the kind of blow-off mania that usually ends a cycle. That sounds obvious, right? But watch what happens in real life. When markets are ripping, your brain assumes everyone is involved. It feels like everybody's in, and that feeling is exactly what causes early selling, or worse, late buying. He gave me a simple sentiment test that hit hard. In a true mania, nobody asks whether they should take profits. They brag, they chest thump, they talk like it's a one-way escalator. But in this room, the number one question people keep asking is, should I trim? Think about that. That's not anxiety. Anxiety is not the same as euphoria. He also gave me a street-level checklist for spotting when the general public is actually arriving. Because it's not always obvious from a conference crowd. First, watch your own inbox. In the early phase, you have to bring up metals to people. In the later phase, people who never cared start texting you first. It goes from, "What do you think about gold?" to, "How do I buy this today?" Second, watch the language. Early on, people ask questions. Late in the cycle, they make statements. They don't ask, "Is this a good idea?" Like they say, "This can't go down." Third, watch the buying behavior. When people start rushing into the highest fee, most convenient products just to get exposure, that's a signal. Convenience buying is usually a late cycle symptom. And fourth, watch what happens on pullbacks. In a healthy bull move, dips get bought without drama. In a topping process, every dip becomes a panic and every bounce becomes a prayer. Now here's why that matters. If you can recognize where you are in that emotional timeline, you can manage your behavior before the market forces you to, because the market's favorite trick is to lure you into confidence right before it hands you discomfort, and if you're not prepared for that discomfort, you'll do the exact wrong thing at the exact wrong time. In a minute, I am going to tell you the one thing he said about energy that made half the room go quiet. Because it connects metals, inflation, and opportunity in a way most investors miss. And one more tell. When local shops start running low, premiums widen, and the casual buyer starts complaining that they can't find any. You're moving from niche to mainstream. That's when the story stops being about price and starts being about access. Access narratives are gasoline on a bull move. You've seen that movie before? Now, do I think there's some fear of missing out happening? That's not always optimal, but psychologically it can stop people from doing something reckless. And 3, you can sell in layers on strength, not all at once. So you don't end up making one dramatic decision that you regret later. And here's the kicker. The method you choose should match your temperament if you're the type who needs Certainty. Don't pretend you're the type who can hold a volatile position untouched for years. Build a strategy that fits you, because a perfect strategy you can't follow is worse than a decent strategy you will actually stick to. I'm saying this because I've watched it happen 100 times. People don't blow up because their thesis was wrong. They blew up because they had no process when the chart started yelling at them. So if you're watching and you're up big, answer this honestly. Would you rather lock in a smaller win or risk turning a big win into a lesson? There's no shame either way. The shame is acting without a plan. But for a new account coming in today, he doesn't freeze up and say, everything's too high, do nothing. He said there are still opportunities across the space if you are willing to be selective and if you are willing to tolerate the swings. And I want to pause right there and ask you something. Be honest, are you actually built for these swings? Or do you tell yourself you are until you see a red day and start doom scrolling? Comment this. When you get a big down day, do you buy? Do you hold? Or do you panic sell? I'm genuinely curious. The conversation shifted to silver, and this is where the room's mood changed, because silver isn't just gold's little brother, it's its own animal. Now I want to be careful here because people love to oversimplify silver. They'll say it's just a leveraged version of gold. Sometimes it acts that way, sure, but other times it behaves like a totally different trade because it is being pulled by two completely different crowds. The macro crowd that uses it as money and the industrial crowd that uses it like a raw material. When those crowds line up, silver looks unstoppable. When they conflict, silver looks possessed. And the craziest part is how fast the psychology flips. One week, people are posting screenshots and acting like they discovered the cheat code to life. The next week, the exact same people are asking if silver is broken because it dropped a few bucks. That's why I keep telling you, the asset isn't the problem, the expectations are. Based on recently published numbers, you can also see this split personality in how different products are being bought. Some investors are piling into easy button products when prices surge, while others are quietly taking delivery or stacking long term. Those are not the same hands. They don't react the same way when volatility hits. The hot money leaves fast. The conviction money accumulates when nobody's looking. So I asked him the uncomfortable question, if silver can be skittish, is it safer to just avoid it and stick with gold? He said, not necessarily. And that's important because safety isn't about the ticker symbol. Safety is about how you enter, how you size, and whether your plan survives a drawdown. He gave an example I loved. If you buy something that's historically volatile, but you only allocate an amount that won't change your lifestyle, you can sit through turbulence. But if you buy something safe with a position so big it makes you sweat, you've created your own danger. That's why I'm always telling people, stop asking, is it risky? Start asking, is my position risky for me? He said gold and silver are being driven by different crowds right now. Gold has a steady bid from big patient buyers. Silver, on the other hand, gets these bursts of retail energy, and retail energy can be powerful, but it can also get spooked. That is why silver can outrun gold on the way up and still slap you on the way down. Here's the part I'll add based on recent market updates. Silver isn't only a speculation metal, it's also a working metal. It goes into electronics, energy infrastructure, and industrial processes that don't care about your entry price. That matters. Because it creates a kind of floor that pure sentiment trades don't have, but it also means silver can get tugged by economic headlines in a way gold sometimes ignores. Two engines, one steering wheel, that's why it whips around. He also reminded me of something most people forget. If you adjust for inflation, silver's old peak is still far away. That doesn't guarantee anything, but it tells you the move can be dramatic without being historically insane. So I asked him, do silver stocks react more than gold stocks when silver moves? He laughed because the answer is yes, and the reason is kind of embarrassing. There are fewer pure silver companies. A lot of so-called silver miners are actually getting a big chunk of revenue from other metals. But the word silver on the label becomes a magnet when the crowd rushes in. People don't read the financials, they read the ticker and the name, and that right there is where opportunity and danger overlap. Opportunity because in a momentum phase, the market doesn't price truth, it prices narrative. Danger because when the narrative flips, it doesn't ask permission. Now, if you've been successful in this metals run, whether you caught a miner early, stacked physical at good levels, or simply avoided blowing yourself up, if you're successful, share your success story in the comments so others can stay motivated. Seriously, people need to see that discipline works. Next, I brought up the question that everyone pretends they're not thinking, is the public finally showing up? He said not in the way that matters, and to explain it, he didn't point to one headline, he pointed to a pattern. Big moves get attention one drip at a time. A major deal here, a big acquisition there, another quarter of strong cash flow, a chart that won't die. Eventually, the average investor looks at their statement, sees their safe allocation lagging, and they start hunting for whatever is working. And that moment when the average investor starts searching for performance instead of safety, that's when a quiet bull market turns into a loud one. So what's the catalyst? What actually makes that average investor rotate? He said it usually isn't a conference. It's boredom and pain. Boredom because the old winners stop performing like winners. Pain because the portfolio that felt comfortable starts bleeding. In the first place, money tends to run when that happens. It's toward whatever has momentum.